From the morning reading, short-term sellers exhaust. Buyers take over, form a bull flag higher low. Watch for bounce. First solar sizzles. 8 of 9 sectors moved higher on Wednesday. XLB, XLE, and XLK were the strongest sectors, while XLF was the weakest sector. Oil futures rose 85 cents to close at $32.22. Breadth strengthened as advancers led decliners 1.81 to 1 on the New York Stock Exchange and 1.77 to 1 on the NASDAQ. Stocks try to stabilize with oil. Short-term trend remains neutral. Banks also bounce with oil in afternoon trading, keeping short-term buy signals in perspective. Short-term trend still uncertain. Stocks opened lower with oil today, but are trying to stabilize with the commodity in afternoon trading. The chart shows a somewhat neutral picture for the market's short-term trend. After successfully testing its January low earlier this month, the S&P 500 tested its early February peak at 1947 and its 50-day moving average. The chart shows the SPX backing off from both of those resistance barriers. That's keeping the market's short-term trend in a sideways pattern. The fact that the 50-day average remains well below the 200-day, however, still presents a generally negative picture. The same is true of energy stocks. Although if they have reached long-term support and are in an oversold condition, upward progress hasn't been that impressive. The chart shows XLE trying to turn positive in afternoon trading. The XLE, however, remains below its 50-day average. Even so, any buying in the energy patch could help stabilize the rest of the market. The direction of bank stocks may also be tied to the direction of oil. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:52 a.m. Central Time, and I'm recording this in preparation for the market day of February the 25th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and go to the overnights and our morning report. And relatively benign last night in almost untypical fashion compared to much of what we've seen of late. The S&P futures at the time of this cut was up about 4 points, or about 0.25%. Russell's up just about scratch. NASDAQ's up about 0.25%, as is the Dow. Crude oil is at scratch. And the euro is up about 0.25%. Bonds are essentially scratch. Gold is down about 0.5%. Not so quiet in overseas action. China down over 6%. Kind of surprising that China would be down so big and our markets would be so benign. Hong Kong also down about 1.5%. And Japan's up about 1.5%, as is Germany. And the United Kingdom is up sharply at over 2.33%. In terms of macroeconomic reports for today, in the United States, you have the weekly variety of the employment claims. Also, you have durable goods and nat gas storage. And in terms of looking forward to tomorrow, we have preliminary GDP, core price index, goods trades balance, personal spending. Also, once the markets open, we have the University of Michigan consumer sentiment, so be aware of that. So we will have quite a bit of information coming out tomorrow. In terms of the current market conditions, our volatility has been somewhat lower of late, though still in an elevated condition. Short-term VIX is at nearly a 21. Skew relatively benign. IV percentile, though, certainly pretty low here, with the S&P in the lower third at a 33, the Russell 37, the NASDAQ 37, and the Dow at a 35. We had no standard deviation moves put in yesterday on a close-to-close basis on any of the 4 U.S. indices. In terms of the charts, let's go ahead and go there. And you see on the SPX, we had this short-term reversal pattern come in, and then yesterday we had the intraday reversal, pretty sharp up. Big wick here. So right now we're setting up as a bull flag pattern, which once triggered, it would trigger about 20 cents above the top of this candle here. So on the SPX, that trigger would be about 1932.28. Once that triggers, the obvious target, of course, is the former resistance area. Not very far to go to that point, and we would be looking to see, can we get through that resistance? That is the real question, and until we get through that resistance with a confirmed close nicely above that, we really, in quotes, have a range-bound neutral market and haven't achieved anything of real significance. Short-term pattern strongly bullish. Intermediate term, though, is clearly in neutral. In terms of some of the other patterns, now, of course, remember the Dow did actually close up above that range, but then nullified that with a false breakout, and then also yesterday had that bull flag pattern setting up. So it'll be interesting to see if that one follows through. That's the most likely one to get a good strong close up above the range and stay there, given its more defensive stance, and so much of the money of late has been rotating towards more defensive sectors and dividend holding stocks like that, which composes the Dow 30. And then in the NASDAQ, of course, has been putting in a series of lower lows and lower highs. But right now, in the very short-term pattern, you have this higher high, higher low, higher high, and then we now have a bull flag pattern. So that's in a very short-term pattern. So if you just focused on what's right there, you have bull flag, and this low here is, I guess, in a similar area as the last bull flag low. So the NASDAQ definitely has more damage to overcome, but it is in a short-term pattern, has been bullish. And then in terms of the Russell, we have a pattern very similar to the NASDAQ in that the primary swing patterns is a lower low and a lower high, though could be setting up in these short-term patterns as something of a horizontal breakout would probably be best described as this current pattern right here. Need to take out that swing high, be able to establish a truly higher high and take out this nearby range in the intermediate term. Volatility has been settling down in recent days. It turned up a couple days ago, and then the big intraday reversal. So it's pretty much where you would expect it. And then bonds. Bonds have also frankly been chattering in a sideways pattern in recent days. Now, bonds should be in rollover, and there's also a lot of auctions going on, I understand, in this market. So this may also be affecting the pattern in bonds this week. You should have contract rollover with the bulk of the volume going to the new contract, which will be the June contract, in the action tomorrow, Friday. Okay, I think that's probably enough with the charts right now. Let's go to our daily report. And on the daily report, we are continuing to see improvement. The intermediate term phase opinions also moved. It's now phase 4. And these are your price patterns near horizontal resistance. That's clearly a fitting description for our current chart pattern. IBD status remains confirmed uptrend. Accumulation distribution score on the S&P, though, remains a pretty woeful D-. NASDAQ also at an E. GMI index has continued to improve. It's now up to 3 out of 6. And it's still on a sell signal, though that author is starting to stick toe in the water and looking for leaders, as it were. So some improvement on the GMI index. Also on the decision point scoreboard, we've had improvement there as well. We now have all the short-term signals as bullish, though the intermediate term is still quite neutral to bearish, and the long-term signals in which these short-term signals are working against are all decidedly negative. So right now, until we start to see some strengthening in the intermediate term, which won't happen likely until we get up above the areas of resistance, you have a kind of a dead cat bounce against a long-term bearish signal. When you put the consensus of all this together, it is a market in transition. It's a market that is in neutral on the intermediate term, and with some pretty strong short-term signals. So you could make an argument for either the bulls or the bears coming out of this pattern. It is just that don't get overly bullish and don't get overly bearish in this pattern. Position sizing opinions are both fairly strong, one at 100%, the other one at 75%. Intermediate term market postures now strongly bullish with a weak bullish sentiment line to help accentuate those impacts. And you see the S&P and the Dow are actually getting to be relatively high in their scores. We've had a number of days now in a row. All four indices are now over the 50 line and are all in the strongly bullish camp. So that also helps. In terms of the hedge warning status, we're currently still a level 1. As we've said, we're waiting for a close above the resistance area to be able to reduce this, and have not yet achieved that. So until we get above that significant resistance zone on the indices, it's always quite possible to go ripping back down to the bottom of the range. In terms of the individual warning areas, relatively benign here. Only the VIX futures up over 18 and the SPX week out move at 50 are flagging in this upper area. Everything down below is also in pretty good shape. On the sentiment indicators, the stock's short-term risk is at a 7, so a little bit elevated. Fear and greed index is quite neutral, nothing to be concerned about in particular there. In terms of special opinions, nothing really changed here from yesterday. VIX is still outside the acceptable window to initiate new positions for novice traders, though more aggressive traders will find that the enhanced premium that's available with these higher volatility levels is of a help. Just got to be ready for those enlarged delta and vega moves. So the way we've been handling that largely is by smaller position sizing and just sprinkling stuff above and below anytime we get a price extreme. And that's worked out pretty well so far in this neutral trading environment. In terms of the other opinions, cover call strategies and put sellings, we're definitely putting on cover calls, but we're also being relatively defensive and very, very picky about where we put those cover calls. Generally, lower beta positions, or at least the same as the S&P. We put on one yesterday in a company that had a 1.09 beta. So it kind of shows you don't get too far out in front of this market until it proves itself otherwise. We also used a ratio of one basically at the money and one out of the money of these strikes, in terms of how to spread that out. So that gives us excellent downside protection on the position, while at the same time it does allow for upside movement, and we could have a very nice return on option by the way we constructed that, and yet at the same time also gives us that defensive posture that we're looking for in the current environment. So these things can be crafted and put together to where you can be engaged with the market, start getting additional delta exposure while at the same time maintaining defensive structures. Put selling, same thing, especially if you're trying to load up on core portfolio positions. You might look at doing things like selling out of the money puts to where you take assignment, or perhaps and kind of a similar process as put selling is buying in the money call, allowing yourself to have a limited amount of cost involved should the market break down, and yet at the same time allowing yourself to take ownership of the stocks if you should want to do that. So it's a couple things that you can do there to get additional delta exposure while at the same time maintaining something of an elevated defensive posture. Market posture has been improving. You see the short to intermediate term are all almost green. Though you see up against this long term, it's a very, very mixed bag with only utilities, consumer staples, and telecom. And guess what? 1, 2, and 3 in terms of defensive sectors, showing up as green across all 3 time frames. In terms of percent change, good day yesterday. Only financials were down. And again, another sign that, this is not a normal, healthy market. The financials, you look here, it's not just the 1 day, but the 5 day, the 1 month, the 3 month, the year to date. The market will never be a strong bull without the participation of the financial sector, and that's definitely been dragging. So that's going to be one of the sectors you'll want to keep an eye on. You can go to XLF to be able to keep an eye on that chart. When that chart starts to get much stronger in a relative term sense to the broad market, that's telling you that the market's truly firming up. So I think that's probably enough there for today. Something I did want to share with you, I did publish a blog article, and if you'll go to this website right here, falconglobaltraders.com/blog. So very simple, falconglobaltraders.com/blog. And you just scroll down a little bit here. You do see where you can click the button right here to become on our mailing list, and that'll get you also a copy of our portfolio strategy ebook. Very simply, it'll just take your name and your email address and put you on there. And periodically, I do send out blog articles or changes in the hedge risk status alerts, those kinds of things. It's not going to pound you in any way, and certainly it's very limited in the number of emails. But yesterday I did publish this, what do I need to know about bear funds? So if you've ever thought about using an inverse fund, and very specifically in working it with your portfolio, there is some discussion here in that article, but you just click on that and it will show you the kind of the concepts of what I'm dealing with. Well, why would I want to use the bear fund instead of rotating the cash? What's the concept of the net long? Why use SH as part of the core portfolio strategy? And then, you've heard that inverse funds don't track well. We discussed that. Also about using ultra inverse ETFs. You just click on the button here and that'll download you the PDF and take you to that article. So I think you might find that of interest. And let's see here. I think that's probably covers you enough for today. We will scroll through the rest of this. If you see something of interest, just hit the pause button, go to the hyperlink, and get the additional details. While we're doing this, we will remind you that if you're watching us on YouTube, like us on YouTube. That's certainly a great way to give us the pat on the back to encourage us to continue to provide this free content for you each market preview morning. You can subscribe to the YouTube channel. If you do that, you'll get a free alert that the content has been published. Wait a couple minutes after you see that alert. Allow that to get fully uploaded to be available to you in high def. Playing it back in high definition makes for a much sharper chart, and that can be important, especially if you've got a relatively small monitor. The other thing about using the YouTube gear, that setup tool, is it allows you to play back, and you can play back the YouTube video at 1.5 speed, and most people will find that quite easily to comprehend, and yet at the same time will take the time during your morning setup down to more like 12 or 13 minutes instead of 19 or 20. Here's the disclaimers. As always, we are not your broker. We're not your financial advisor. We have no fiduciary relationship with you. We are an education and opinion, and that's all it is. So if you want to see the full set of disclosures, just go to that hyperlink down there at the bottom, and that'll give you more disclosures than you could read in a while. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading to everybody.